Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. I'm Barry Schwartz, joined as always by Ernest Wong. Thanks for joining us today. We have so many fun topics to talk about, Ernest. The tough month of February for sure we want to get to, as well as talk about the Buffett letter, Couche-Tard deal, maybe back on the table, some interesting shareholder news about Ferrari, and then maybe a quick review about National Bank and Domino's earnings.
Sounds good.
Sounds great. So if that sounds good to you, we'd appreciate if you would subscribe to our podcast on YouTube, on Spotify, on Apple. If you give us a 5-star review, we really appreciate it. Tell your friends. And we really will hope that you keep coming back to hear us talk about long-term compounding. And so, Ernest, for long-term compounding, you got to stay invested for the long term. Yep. You can't dance in and out of stocks because you're worried about this event or that event. No question, the tariff event is a worrying event. No question, there's a lot of uncertainty. But keep in mind, stocks have already fallen. Keep in mind, we have no idea when tariffs go in, how long they'll be in play, how bad it will be, what will be the recovery, what will be the offsets, of course. You know, if investing was like a math formula where you knew the variables, right? You knew what A was and you knew what B was, you could easily answer C. Right? A plus B equals C. Most people assume that that's how investing works too. Bad news, A is going to happen. Therefore, B, I should sell my stocks or take defensive action because that's going to be the end result. Well, we're here to remind you that that's not the case in investing. You don't know the variables involved in the math problem of investing. There are offsets. There are adaptions that could happen. I remember everybody was worried during the pandemic. People were worried about what's going to happen with interest rates and inflation, all those things. The market turned out pretty well. I think I've said it before. The last 5 years have been spectacular. S&P 500 up 17% compound over the last 5 years to the end of 2024. I don't think those are reasonable expectations for returns going forward. Maybe we'll give some of that back in the medium or short term. Hard to know. But our goal, and we're going to reference what Buffett said, you got to own good companies. You got to stay invested with the good businesses. And that's what we're going to do. And so we're hopeful that we own great businesses that will survive through tough times and maybe even come out of those tough times even better. That's definitely been the case for most of those investments since we've owned it. So that's the strategy we're going to take. We're not doing anything much else but sticking to our investing acumen. So with that, let's talk about the Warren Buffett annual letter.
Let's do it.
All right. So Berkshire Hathaway, all-time high. I guess Buffett is pretty happy that he's sitting on a lot of cash right now because, cash is paying quite well. The market's been very lumpy, but under the hood, there's some things are starting to turn around, some really good results on some of the business lines. And so let's chat about some of the insights we learned from Buffett this year. 94 years old, by the way.
Yeah, I don't think we're going to be getting too many more of these letters.
Yeah, that's the sad thing is he referenced in the letter that it won't be too long now before Greg Abel is running the business. I mean, kind of sad to say that. Buffett also is preparing people for a shorter annual meeting this year. He just doesn't have the stamina at age 94 to answer questions for 10 hours. Also, he's let us know that he has a cane for walking. So, there's some nuggets of information that we're learning, but I don't know. The guy's 94 years old, $1 trillion market cap, looking pretty smart. So far what he's doing is very good. So Ernest, let's touch on some of the interesting insights we learned. Go ahead.
I thought he slipped in a lot of interesting hints about things that people are often talking about with Berkshire. So the first is Greg Abel,
Yeah.
who is going to be his successor as the CEO of Berkshire Hathaway.
Yeah, not a surprise anymore. Buffett has named a successor, named a CEO when Buffett ultimately steps down or what happens, and that will be Greg Abel. Greg has been with Berkshire for a very long time, running its energy business.
Yep. Yeah, he's run a couple of their divisions before, and there has been some buzz going around that Greg Abel was there he's not going to be a capital allocator in the way that Buffett is buying and picking investments and buying stocks. He's there just to focus on the operations of the business, and maybe, that the reason why Berkshire was selling shares in Apple and raising cash is to prepare for this, to prepare for his death, so that Greg wouldn't have such a large overhang of a burden to manage the portfolio of Berkshire.
That was my initial thought, and I tweeted about that when there was two or three tranches of Buffett selling down his Apple shares. I said it's ludicrous. The guy is close to retirement, and 50% of the investment portfolio is in Apple. 25% of the market value is in Apple. I mean, unbelievable investment, but it's not prudent for Buffett to leave Berkshire Hathaway in this situation. And rightly or wrongly, he trimmed the stock. Probably a very good time to do it, although the stock has gone up since he's trimmed it. That was the argument. Everybody said, he's selling it because Apple's had its best days, or he's nervous about the markets. This was not our takeaway, or at least not mine.
But he very clearly said that he thinks that Greg is a very good is a very good investor.
Interesting.
And that he has, here's the quote exactly. He's basically talking about buying stocks at cheap prices. So in the letter, it says, often nothing looks compelling. So no share prices are compelling. Very infrequently, we find ourselves knee deep in opportunities. Greg has vividly shown his ability to act in such times.
That's a very good compliment. So he's essentially saying Greg has the skills that I have to allocate when the opportunities are there, and not to hesitate.
Yep. So that's one thing that he put to rest. The other thing that I think that he emphasized quite well is the performance of Todd Combs. I think a lot of people have kind of looked at the picks of the names that Berkshire has been buying and kind of track the performance and attribute them to Todd and Ted and say, it doesn't seem like they're very good investors.
Yeah, he could have just hired the S&P 500 for a lot cheaper to run the non-Buffett portfolio.
But he specifically gave a shout out to Todd for his efforts in turning around Geico.
Yeah, but not on the investing side.
No, not on the investing side, but at Geico, because Todd was made. He is leading Geico today. Geico was not doing very well a couple years ago.
For those that don't know, Geico is one of the leading property and casualty insurers in the United States, primarily on auto.
Right.
And at one time was the biggest, losing market share to Progressive.
Yep.
And also bad results for a number of years. And all of a sudden, things are turning around really good.
Yep. And the improvement in performance at Geico, partly due to Todd's, under his leadership, that was probably the single largest driver to improved performance at Berkshire in 2024.
Yeah.
So great job by Todd.
We love Todd. And part of the reason why the stock's at an all-time high is just the stunning reversal in results at the insurance division. I'm just skimming over, trying to off your cheat sheet here, just to look at the insurance underwriting business for the quarter. Essentially, earnings doubled year over year.
And that was almost all Geico.
It's almost all Geico. So great job. But let's hope that that's a trend that will continue in the insurance business. Insurance is the leading driver of earnings at Berkshire, right? I guess.
Yep.
Insurance and investments at the insurance business.
Yep. Those are the biggest ones. I think the rest of Berkshire's portfolio overall was kind of blah.
Yeah.
There's dozens of businesses there, like from Dairy Queen, Fruit of the Loom, See's Candies. I think those are those are good businesses, but not really growing as a whole.
Their businesses have spin off a lot of cash flow.
Yeah.
The railroad business, 2024, still another tough year. If you look at the Canadian railroads, they didn't really have that great results either. Many are hoping for an improvement in 2025, although tariffs. The one interesting thing we talked about last quarter, sorry, I bit my tongue so bad last night, so talking hurts. But yeah, don't do that. Don't bite your tongue when eating. So one of the things that we learned is that Berkshire, I think, hired not a CEO, but someone to help improve the operations at Burlington Northern, right?
Yep.
Yeah. More the precision railroading, something that Buffett said he probably was never going to do. He's doing that, given the poor results. So we're hopeful if there's a turnaround in insurance and a little improvement in the railroad, you're looking at a company that's got some pretty good growth going forward.
Yeah, I think when I think about Berkshire as a whole, I think about Berkshire as a group of businesses that more or less kind of resemble the U.S. economy.
Yeah.
Maybe without the techie aspects, but they're more or less going to match the GDP growth of the U.S. over time. At some of the businesses, they have good leaders. Others maybe not as great, as he alluded to in the very beginning of the letter. But you add to the fact that Berkshire is deploying the capital smartly into investments like Apple or recently like their oil investments. We'll see how that plays out.
Yeah.
And over time, you should have roughly S&P 500 like returns with hopefully below market volatility.
That's right. And okay, very interesting. One of the things that I found interesting to talk about was when Buffett starts referencing the investments of the stocks, right? So a very important point, he says, yeah, we raised a lot of this cash. I think going back, trying to understand why Berkshire has a lot of cash, some of it is just the insurance business is growing, and the Berkshire needs to reserve a fair amount of cash against it. So it's always going to maintain a huge cash balance. Number two, I think Buffett...
Right, like if there's a big hurricane or something.
Anything could happen, right? The second thing is, I think the pandemic totally scared Buffett. And I think he wants to be more prepared going forward in the next downturn that happens. That's my personal take. But more interesting is he said, equities are still going to be the biggest thing in our portfolio. We're not switching from stocks to cash. And here's our favorite stocks. We like Apple, we like Moody's, we like Visa, American Express, and what else did he like?
Coca-Cola.
Coca-Cola. The four big concentrated positions that Berkshire has. Berkshire, I think, at one point owned 5% of Apple. It owns 21% of American Express. How much of Coca-Cola? I have no idea, but
those actually aren't his largest positions.
Really?
He owns more Bank of America, and he owns more Chevron.
Yeah.
Than
and Occidental.
Yeah, and Occidental. But you can't. The whole point that he was trying to make was that these are that it's good to own businesses with high returns on tangible capital.
Very high returns.
Very
is
high.
The words he used.
And Bank of America and Chevron maybe might do all right, but they might be undervalued. But those are not businesses that have high returns on tangible capital.
It's so funny. Buffett references the types of business that he loves. These high quality, same businesses that we love. These high quality cash flow type businesses with low capital expenditures. Yet you look at his portfolio, and why don't you own more of those type of names, dummy? And and we could learn, I guess, a lot from that too, right? His best investments are those four that he's held for a long time. I bet he wishes he never trimmed any Moody's.
Yep.
I don't think he's trimmed any American Express. Coca-Cola, people still beat him up for not trimming it, but his compound annual return, total return on Coca-Cola has still been incredibly amazing without paying any taxes.
Right. I think that's the thing that people don't appreciate about Berkshires when they own names like Coca-Cola is that they don't pay tax on a lot of the dividends, I think.
Yeah. You don't pay tax, and you don't pay tax if you don't sell. That's the point I'm trying to get to our clients. Once you pay tax, 25% of that is gone. Bye-bye. So if Buffett's telling you that the Mount Rushmore, the four greatest businesses in the world, are the best businesses that you should own, have very high returns on invested capital, generate a lot of free cash flow, we should really pay attention, stop and read that a number of times, and trying to understand why we don't own American Express and Coca-Cola. But
Maybe we should.
Maybe we should.
Also likes the Japanese trading houses.
Yeah, has that been a winning trade for Berkshire?
Oh yeah.
Yeah.
Yeah, I don't remember exactly the year he bought it, but he's doing well on them, and he said he wants to buy more of them.
He owns 5 meaningful stakes in Japanese conglomerates.
Yep, and these are large companies in Japan that that participate kind of in every segment of the economy. Mm-hmm. One of which we'll talk about a little bit later. But when Buffett calls something out in a letter, it's interesting because it's something that Buffett chooses his words very carefully. He has always been very careful with what he is choosing to present out there. And in the case of the Japanese trading houses, it's interesting because Buffett's always tried to be the American investor guy, right? Mm-hmm. I love America. America is the greatest country in the world. We're always going to be investing in America. Yeah. But then you own these trading houses in Japan, and then you own BYD in China, yeah, right? So what's going on there? And so maybe he felt like there was something that he needed to clarify with the investment community, with the investors, and why he wanted to make money there. And,
I don't care how you make money, Buffett, just make us more money. The interesting thing that he said in that point about the Japanese trading houses is he hopes Greg Abel will be holding these for many, many years to come.
Yep.
So he sees these as another amazing business like the railroad or Apple, or Coca-Cola. It's something in the portfolio that he thinks Berkshire should hold forever.
They specifically noted out their capital allocation abilities, mm-hmm, and how they buy back stock cheaply.
Yeah. Those Japanese trading houses, the reason Buffett is always attracted to low valuation stocks, and at some point a number of years ago, those names were trading at single-digit PEs with nice cash balances. The big knock on the Japanese companies is their shareholder how they treat shareholders, how they think about capital allocation, and maybe things have changed in Japan. And so, are we done talking about Buffett?
No, I think the big overarching takeaway for Berkshire, if you look at his actions in terms of what he's doing with raising cash, and you kind of read between the lines in what he's writing in the letters, yeah, is that he thinks that there are not a lot of opportunities for Berkshire to deploy capital today, which is, not really a surprising thing to say.
Yeah.
And that he wants to wait for the opportunity, market drops happen, and he wants to be able to deploy a massive amount of capital very rapidly. Yeah. Whether it be buying a company outright or, buying stocks.
Yep, or lending money to those that need it at very very nice rates.
And whether it's him or whether it's Greg, because something happened to Buffett, that's what investors should be waiting for.
Yeah,
so that's really the big takeaway that I have.
Yeah, you never know what's going to happen. I'm sure Buffett is thinking about deals and opportunities every minute, every day, like any other passionate investor. And when the opportunity presents himself, he's certainly sitting on a lot of cash to do it.
Right.
Given the uncertainty with the tariffs and right now, he's like anybody else. It's probably best to wait until the dust settles before making any major capital expenditures or any big, large investments. It's very tough unless things fell really hard. So, speaking about Japan, we got news out the other day that it looks like Couche-Tard's possible acquisition of 7-Eleven is a go again.
Yep.
And it looks like they're the front runner. From the press release that I read, or from the news article, it definitely seems that the Japanese family that owns 7-Eleven or controls it is interested in talking to 7-Eleven again, and to Couche-Tard again, and seeing if they can find a way to make a deal that wouldn't be blocked by U.S. antitrust regulators. So sounds very positive.
So the background on all of this for people who haven't been following the story is that in August of 2024,
Yeah.
Couche-Tard, which owns Circle K and is the largest Canadian convenience store operator,
Yep.
they made an unsolicited bid to acquire 7-Eleven, which is a Japanese-based company. It's the largest convenience store chain in the world. And 7-Eleven really didn't want to be acquired by a Canadian company. Like they really didn't want Couche-Tard to buy it. But they had activist shareholders on the board. The stock price hadn't done anything for like a number of years.
Yeah.
And so there was pressure on the board and the management to come and do something about, really take the bid seriously. And so what happened was that the family of the son of the founder of 7-Eleven, he decided to try and take over the whole company. And the way that he was trying to raise money this would have been the largest leverage buyout in the history of the world.
$58 billion leverage buyout.
Yeah.
Insane.
And the way that they were trying to raise money for this buyout was almost like the way that I try to look for players in for my basketball team.
Yeah.
It's like knocking on guys that you knew like 10 years ago and be like, hey, do you want to come join me? It's going to be fun. Like we're going to make money together.
Yeah.
And
so calling up every company in Japan that he knows about, every private equity business in the US and Europe.
Like this Thai family was really all over the place.
Yeah.
But
throwing a couple bucks here and there and so it can get up to $58 billion.
But yesterday we found out that Itochu, one of the trading houses that Berkshire owns, they said they're out.
They're out.
And without Itochu, there's no way they're going to get it.
Itochu is going to lend $5.8 to $6 billion to help take this company private. And for whatever reason, whether they saw the deteriorating economics, the uncertainty in the world, who knows? Higher interest rates, why? They said goodbye. And so that the deal is dead.
And when Itochu said they were out, I think other people said we're out too.
Yeah.
So no management buyout.
Yeah.
And now they have to take Couche-Tard's.
They have to take Couche-Tard's off. They have to. So the stock, the 7&I stock is trading about 2,100 yen.
Yeah.
So prior to Couche-Tard's offer, 1,700. The stock got up to 2,600 yen when a share when it looked like the family was going to get it back into the buyout. That's off the table, back down to 2,100. If Couche-Tard walks away or they say no to Couche-Tard, stock's going back to 1,700. And that's, I mean, I don't know if they care about money or not, but if I was a shareholder, I'd be pretty upset. There's a pretty good offer on the table. In the meantime, has 7-Eleven gone ahead and sold some of their assets?
Yeah, so I think the actual amount that Couche will have to pay in the end, if the board decides to accept their offer, is probably a little less now, because throughout the whole process, they did carve out some of their non-core assets. So the supermarkets, like everything that's not the convenience stores. And they found private equity buyers. So Bain is going to be paying about, I think, roughly $5 billion US for some of their for their supermarket and other stuff.
Okay.
So that will help Couche-Tard not only with the financing, but also in really buying the stuff that they care about, which is the convenience stores.
So if we go back to some press articles, interviews with Couche-Tard management a few months ago, how are they going to get this deal done? Well, they said they're not afraid to use a lot of leverage. They're not afraid to stretch their balance sheet to 4 times levered versus, I think it's 2 times right now.
Something like that.
They're not afraid to dilute slightly themselves on equity, but not crazy. They feel that the combination of the two companies will generate an enormous amount of free cash flow that they can pay back debt in 2 to 3 years, or at least get it down to a more reasonable level. And they feel that the combination of the two companies will really be significantly accretive to earnings. So Couche-Tard stock has been under pressure, Ernest, over the last few months. Part of it due to macro. Part of it just due to uncertainty about this deal. Maybe things will start turning up positive at the Circle K.
Well, I think on a big picture, I really think that this is a very attractive opportunity for Couche-Tard. And I think it's natural that investors look at this deal and go, well, is the management just and the board just trying to, empire build the company, just grow for the sake of growing, and they're going to blow up the balance sheet. There's going to be a lot of leverage, and it's like really scary.
Yeah.
But what I like about, well, first of all, the reality is that even at the price that Couche-Tard is offering, they're only paying about, like, they're paying a significantly lower price multiple than their own stock. Mm-hmm. So it's a very opportunistic bid at a time when 7-Eleven is not doing very well, and at a time when the Japanese yen is trading at a discounted value. Mm-hmm. So there is a very opportunistic timing element of the deal. And the second thing that I really, really admire about this whole initiative is the extent to which the four founders, who still own a large majority of their net worth in Couche-Tard stock, they're super confident about this deal.
Yeah.
Because when companies do these large kinds of acquisitions or major investments into projects, I think like me or you might have our own opinions about the attractiveness of the deal. But I think what matters even more is, does the management really believe in what they're doing, mm-hmm. right? Like, are they putting their money where their mouth is? Because it's one thing to go out and spend like $50 billion, but it's another thing if you're fully aligned with the shareholders.
The four founders, I think, own billions of dollars worth of Couche-Tard stock. They are totally aligned with wanting you and them to make money on this deal.
And the fact that they came out publicly and said, we'd rather use debt because we don't want to get diluted and we mm-hmm. want the upside from the deal.
Yeah.
Like, that's exactly what I want to hear when I'm, evaluating something like this. So that's, yeah.
So talking about families selling stake in investments, Ferrari's one of their, is it the founding family or no, it's an investment company.
It's an investment.
An investment company. When Ferrari went public, had a meaningful stake in Ferrari. The holding company is called Exor.
Yep.
And it's the Agnelli family.
Yep.
That controls Exor. Long story short, Ferrari, since going public, has gone up about 10 to 15 times.
Yeah.
So the Exor stock, the Exor portfolio, pretty much had 50% of its holdings in one stock, Ferrari, as a result of, we talk about it, owning good companies, being patient with them. It's worked out tremendously. And so they announced that they're going to reduce their stake by 20%.
Yep.
That's prudent to me. Ferrari stock is obviously pulled back as a result of that. I mean, they have to market a fair amount of shares. 7 million shares are going to be sold.
I think it was a 7% discount.
Yeah, and at a 7% discount to get those shares sold to institutions. In the meantime, Ferrari has announced that it's going to buy back $300 million worth of the stock. I think the share deals they're offering is $3.5 billion or
something like that.
So small portion, but still shows confidence. This is quite similar to what Berkshire did with Apple, right? It's you can't have all your eggs in one basket, even if the basket is beautiful like a Ferrari.
Well, I think the other aspect for the Exor mm-hmm. deal sale in particular is that Exor stock trades at like a 50% discount to the market value of its assets.
Yes. Why is that? Some of the parts type plays.
Well, I think oftentimes with these kind of investment companies, like you see this with Brookfield.
Power Corporation.
And it's very common that they trade at a large discount to mm-hmm. net asset value for whatever reason. Mm-hmm. And so in this case, I think the management thought that there was an opportunity to, take a little bit of money off the table, use it to buy back Exor stock, mm-hmm. and in essence, create value that way.
Yeah, I don't think there's too much more you can glean into that. They're not selling their entire stake,
and they still own 20%.
Yeah, and it's still a massive position for Exor, and they're committed. They said in the press release to holding stock for at least 1 year. We'll see what happens there, but eventually founding families or major owners shares will change, right? People, this is what happens with companies, but their time horizon may not be our time horizon. Let's move on to finish off about earnings.
Okay.
Like last week, we talked about good earnings and bad earnings. Both these companies reported, one actually reported great earnings and the stock went down. One reported meh earnings and the stock's gone up like 15%. Right? So
Not immediately.
not immediately. Yeah, there was a delayed reaction. So the earnings don't always matter in the short term. It's guidance. It's what's going on with the macro. It's how you're positioned, how the stock is done leading into the earnings. Specific items that were positive to the earnings that market discounts. So the first stock we're going to talk about is National Bank.
Yep. Okay. So National Bank announced earnings yesterday. So today's, I think, the 27th.
It is February 27th. Almost done for February.
Yep. They announced earnings for the September to December quarter, and I think the stock fell like 4%. Because
5%.
5% because they expect 2025 to be a bit of a weaker year versus 2024. And some of that is due to Canadian Western Bank, which they bought, that they're still in the process of fixing up the cost basis.
They just closed the deal February 3rd. It's going to take them many months to figure out how to integrate it, which divisions to bolster, to get rid of, which people to keep, to get rid of. And
so that's been a bit of a drag for 2025, but still very excited going forward. And then overall, like the macroeconomic environment in Canada is, I think to no one's surprise, not very great.
Not very great. And the uncertainty of the potential upcoming tariffs means that you should be prudent as a bank. If you were running a bank today and there's a potential of a possible major tariffs to your customers and it would impact your customers' cash flows, you might reserve a little bit more capital against those potential hits that could happen.
And I think you are seeing that with National and with Royal.
Yeah, Royal announced this. Today's February 27th. Royal announced earnings this morning. Same deal.
They were seeing specific files where in their commercial loan book where there were some write-downs that they had to take down. And I think like overall it's not super material to the bank's overall balance sheet, but I think that's kind of what you would expect in a weakening macroeconomic environment.
In banking, the trend is your friend or not your friend. And so in the banking industry, when you start seeing loan losses start to rise and banks start to increase their guidance range for potential losses, that gets people nervous. Are we going to have a recession? Are things going to worsen? How bad is it going to be? Right. And so the earnings for banks are all great until they got to start taking write-downs left and right. We've been through this before in many recessions. You can wipe out a lot of earnings with write-downs. So I think it's smart of the banks to be prudent, to take some potential reserves against releases that could happen. And in the meantime, the positive thing to say is for National and Royal, their trading houses, their wealth management businesses are really doing excellent. Part of that, of course, maybe just a good stock market, but
I think that's the element that like nobody really knows what will happen because the wealth management business is it's like Baskin. They own stocks and bonds for their clients. If the stock market goes up, earnings go up. Stock markets go down, earnings go down.
Yep.
And same thing for the capital markets, where in good markets, people like companies are going to be raising more capital. In bad times, they're going to be
sitting on their hands. Yeah, that's just the way it goes.
I think that was one reason where 2024 was a great year for both of those businesses.
Incredible year.
So I think there's expectations that's probably going to slow down a little bit in 2025, even without the what's going on with the tariffs.
In the meantime, guidance is so difficult. Even if you give guidance for the next 3 months, things can change so rapidly in any business, and it's always prudent to give conservative guidance if you're going to give it. I don't think there's too much more insights. We're not going to do anything with our National and Royal holdings. We like those banks. We think those are the two of the best quality banks. You can see it by the returns on equity that those banks delivered versus their peers. Always top tier. They're both sitting with nice capital, good protection against bad stuff happening. And even if tariffs do happen, at some point they will end, and the economy will rip roar again, and we feel good about owning the better quality businesses in the banking industry in Canada.
I think that's a good rule for every sector.
Every sector. So the company that reported decent earnings, I think it missed by a little bit, same store sales were down, was Domino's Pizza, right? So Domino's, this is one where Domino's is really the last few quarters, Ernest, has missed the street on a lot of estimates and guidance, but the stock has been grinding higher. I mean, missing the street is one thing, but you look at the fundamentals, Domino's really had a good year in 2024, right? No one's talking about that, but I think earnings were up like 20+%.
Well, I mean,
earnings per share.
I think some of that is just due to accounting related issues.
Okay, yeah.
But no, Domino's is doing really, really well in an overall tough environment for the restaurant industry, because I think if we look back maybe 3 or 4 years, like everybody was eating out, things were great. I think people were getting like government subsidies and they were working from home. So there was a lot of spending for eating out at fast food restaurants and, full service restaurants as well. Then 2022 happened and food prices and labor prices started to go up. Everybody raised prices to reflect that. And then consumers looked at that and say, I'm not paying $20 for a Big Mac combo.
Yeah.
So
is that how much a Big Mac combo costs? $20?
In certain places.
Oh my.
Well, the prices are set by the franchises.
$20 for heartburn. Okay.
Yeah. So they say, I'm not paying $20 for a Big Mac. I think I'd just rather cook at home.
Yeah.
Or if I'm paying $20 for a Big Mac, I can eat at a nicer restaurant and not have to eat McDonald's. So
makes sense.
That's kind of the pressures that the whole fast food industry as a whole has been facing for 2 years now.
You've seen it in the same store sales of most fast food restaurants, right? Declining same store sales or flat same store sales. So that's evidence to your point.
And I think Domino's, they're not immune to any of these pressures, but they're still gaining market share. They still had positive same store sales growth, most of which was driven by order counts.
Yeah.
And that was an environment where their most like Papa John's and Pizza Hut, they both had negative same-store sales.
Not only for this quarter, but for 4 quarters in a row,
Yep.
I think. Yet Domino's Pizza for the last 4 quarters has had positive same-store sales growth, both international and, I think international had one down quarter.
No,
but,
it was up.
Yeah, but overall, up.
No, it was.
So Domino's, that means they're taking the market share. People like their pizza. They like their prices. They like what they're doing with delivery and the special. I think Domino's has also been aggressive on deals.
Yep.
Emergency pizza and coupons and what have you. That does take a toll on margins.
Yes, on franchisee margins.
Yeah.
And I think it's just the reason that they're able to have good same-store sales relative to the tough industry overall is because of good execution on things like marketing. Yeah. I think they just launched selling on Uber.
Yep.
Which has been another boost for their profits.
They signed a exclusive deal with Uber till May 1st, 2025. Most expect after that they will sign a deal as well with DoorDash.
Yep.
And
where you can order Domino's, but Domino's will deliver it for you.
Yeah.
Through Uber and DoorDash.
So people do that because they sign up for the Uber One or the DoorDash Plus, and or Skip the Dishes Plus, and because they're paying $10 a month, they get free delivery.
Yeah. So what? Maybe we're getting a little off topic here, but
people like it.
But what ended up happening with these food delivery apps is that they now have a core group of people who rely on these apps to decide what they're going to eat. Yeah. It's like a small group. Well, it's not a material portion of the population, but there's people who...
It's like Netflix.
Maybe they have... Well, Netflix is... Everyone watches Netflix.
Yeah. But what am I going to watch on Netflix now?
Right,
what am I going to order on DoorDash now?
Exactly.
Yeah.
And these are maybe higher income consumers who maybe have families and don't have time to go out and pick up Domino's. And Domino's wasn't able to reach these customers because they were only deciding what to order through Uber or through DoorDash.
Who owns Skip the Dishes, by the way, in Canada?
Skip the Dishes, I think, is
Just Eat
Takeaway, which is been a disaster, by the
Yeah.
way.
I used to order from DoorDash, but they would always deliver to the wrong house, and only Uber Eats would get it right. So I'm now an Uber Eats guy. I will never order from DoorDash because I was too frustrated. It happened like 5 times in a row. For whatever reason, my house was not picking up on the GPS.
No, but the key for that is the key for Domino's is that they're the ones delivering the pizza.
That's right.
So it wouldn't be an Uber driver.
Yeah, it'd be Domino's. Okay.
Yeah, and the reason they did that is because they think they can deliver better than Uber.
So the stock earnings were meh. The same store sales okay, but not great. So what gave the market confidence for the future, given that the stock has gone up since reporting earnings?
Well, I think it's the fact that they think 2025 is going to be another good year relative to the targets that they had originally set out at their investor day in 23.
Yeah. Okay.
The fact that they're gaining market share over their competitors very clearly. And the fact that they're just executing on marketing and on new products and on delivery speeds, and the franchisees on, the ones that are actually running the store, like everybody's doing a great job.
And isn't it interesting that Berkshire Hathaway continues to add to its Domino's pizza stake, a company that fits the bill with very high returns on equity and tangible, right?
I love Domino's because I think it's a perfect example of a company that is executing on things that matter to the performance of their business. But whenever I talk about like their dough stretcher or their ovens, or, that fact that they're launching a new mac and cheese, nobody cares because it's not, that's the type of thing that we pay attention to when I'm evaluating a company, and less so about whether tariffs are going to drag Canada into a recession.
How the company's going to improve results going forward. That's all we care about.
Exactly.
Yeah.
Because at the end of the day, like the managements of these companies are like, they're seeing the same headlines that we are.
Yeah.
But it's their ability to adapt and execute in the face of these issues that's going to drive their business and their stock price going forward.
Any hint about stuffed crust? People are anticipating that Domino's is going to launch a stuffed crust. Is that something that's going to happen?
So the reason why there's this rumor is because every other chain has stuffed crust.
Yeah.
Domino's doesn't.
It's gross, by the way. I don't like stuffed crust, but anyways, yeah.
And the fact that they're rolling out the new dough stretching machines, which allows them to make stuffed crust.
Insert the cheese into the crust.
I think it'll happen at some point, and maybe you can order one for the group, the team here.
Well, that's just if the stock keeps going up, for sure we will. So Ernest, going forward, I think we'll do another mailbag segment. So we'll ask you for your questions very shortly. And upcoming episodes, we definitely want to talk about Constellation Software and Topicus
And the energy sector.
And the energy sector. So we got so many things. We'll never run out of things to talk about as long as the market goes up and down every day. And Donald Trump is still the president. So with that, we bid you adieu, and we hope we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.